that most people think that when I mean Fed broke the banking system, they're thinking Silicon Valley Bank, they're thinking First Republic. And the answer is yes and no, because the damage done there is probably 1% of the damage that the Fed is doing to the banking system in other ways.
These 20%.
I'll take 4%. I mean, but when it's 10 or 15, then delinquency rises. All of a sudden, tenants are leaving, and churn is the killer of profit. You don't really do the math on that. You might be getting 15% rent growth, but all of a sudden, instead of people leaving every 3 years, they're leaving every 9 months. As far as I know, no bank has done that at this point of time, even though hundreds and hundreds of these buildings have already gone under in the last 6 months. It's the Fed's breaking the banking system in pieces, in steps every single month, because these small and mid-sized banks were the biggest lenders to commercial real estate, especially the office segment.
Now we do have a special guest. Our guest is Neal Bawa, and he is a technologist who is universally known in the real estate circles as, get this, the mad scientist of multifamily. Besides being one of the most in-demand speakers in commercial real estate, Neal is a data guru. He loves public speaking and is an energetic and humorous speaker. He also serves as CEO at Multifamily University, an apartment investing education company. He is a top-rated in-demand presenter at conferences and events across the country. Over 5,000 students attend his multifamily seminar series each year, and hundreds attend his apartment magic boot camps. Tens of thousands listen to his podcast appearances, and he's been featured in over 150 top-rated podcasts and radio shows. Neal's asset management and revenue optimization techniques for multifamily are considered unique in the industry. Neal, holy smokes, that's an awesome resume. Welcome to.
Nobody ever reads that far, but thanks for having me on the show. I'm very excited to be on.
Great, and so the title for this episode is "The Fed Broke the Banking System." So we want to get your thoughts on that. First of all, how did you come up with that title?
Well, I think we wrote that title a while back, and the Fed actually has started to heal the banking system. A lot of it was really tied to what happened in March and what is likely to continue to happen. So a lot of people are like, well, in March, a bunch of banks failed, and then it sort of all went away. And the answer is, well, it didn't really go away. It became less noisy, and you stopped seeing headlines about it, right?
So like when Silicon Valley Bank failed, and then
that's right,
Republic failed, Chase took over them. Actually, what happened to Silicon Valley? Did another bank take them over?
Yes. So this happens in 100% of cases, right? Yeah. So every time a bank takes over, immediately the FDIC comes in. The first thing they do is they change the name of the bank because the name is tainted. So all of these Silicon Valley Bank locations, I live in Silicon Valley, so I should know. All of the locations are open. They're just fine. Basically, they instead of selling that bank to another bank, they sold them piecemeal to a bunch of different banks.
Gotcha. And what I thought was kind of interesting is, you hear all the conspiracy theories about why the FDIC covered more than $250,000. Someone pointed out this, and I thought it was kind of interesting that, if you're a $1 billion company and you have $500 million sitting in the bank, I mean, it's just ridiculous to go, well, if we're going to, make sure everything's FDIC insured, we're going to have 1,000 different bank accounts at less than 250. And I know there's ways around that, but for some reason, it didn't really bother me that they covered the insurance for more than 250. But on the other hand, you got to kind of make sure no hanky panky goes along, right?
Absolutely. And actually, one of the things that folks like us do, right? So I currently have about $75 million in the banks in one of my companies. And the way we do it is there's actually a program. And what this program does is you put your money in to, let's say, Comerica Bank. Comerica is the bank that, holds our assets. And then Comerica then takes the money and puts it in $249,000 chunks into a bunch of other banks.
That's what.
And so my $75 million is 100% FDIC insured because it's actually sitting in 3,000 banks. Gotcha. Or something like that, some weird number like that, 300 banks. So it's sitting in 300 different banks, and they give you that list. But the way that the system functions and the FDIC oversees it they spread it out amongst a bunch of different banks, and you can actually go to those banks and manage the accounts, yourself. But obviously, it's going to be a hassle to do that to 300 different banks. So if Comerica goes out of business, the FDIC comes in and it takes over the control of that system that I just talked about and hands it over to another bank. And now I can transact again within 24 hours. So it's a very interesting system.
I think it's brilliant, because it totally makes sense that, if you as an individual have to start going to 300 different banks, it'll just drive you bananas. And so
absolutely,
it's a nice legal way, let's say, of getting around the system. Neal, we'll ask you this question, see if you know the answer to it. Bill Russell holds the record for the most NBA championships won as a player. How many did he win during his career?
I'm just going to guess. Bill won 6.
Actually, he won 11.
Wow.
Isn't that amazing?
Wow.
He won 11.
That's a stunning number.
The Celtics back then were an absolute powerhouse. Also, I want to make a mention here for the Elk Cove Inn in Mendocino, right on the water. If you just check them out, just look at the pictures. It's just a beautiful, almost like a bed and breakfast, beautiful place called the Elk Cove Inn in Mendocino. All right, we are in the studio, somewhat Zoom-wise, with Neal Bawa, who is the mad scientist of multifamily. Now, how did you get that moniker?
It happened actually in a weird way. I was walking up on stage. So they were introducing me at some conference. I usually go to about 15, 16 conferences a year that I present my data at. I'm the, I'm the data guy. At a lot of these conferences, some of them are sort of pitch fests and people are pitching whatever the heck they want. And they want to have one data guy that shows up, basically just goes through a bunch of information and doesn't necessarily point people to anything. I'm the token data guy. And so as I'm walking up on stage, this guy says, this guy, blah, 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 blah. And he says, mad scientist of multifamily. And the audience just starts to yell and he's really taken by it. And then a month later, he's hosting a different conference and he uses it again. And then I'm like, and the audience reacts the same way. And I'm like, this isn't bad. It actually describes who I am. So I'm just I'm gonna steal it.
Absolutely. So I've been to these conferences before, and people are pitching whatever they're trying to sell,
right?
What kind of, pretend we're at a conference right now. What kind of data points are you sharing with the audience?
So and it varies from time to time, right? So I'll talk about data points related to what you asked me, right? So a little bit earlier, you asked me this question about how the Fed broke the banking system. So what I talk about is that most people think that when I mean Fed broke the banking system, they're thinking Silicon Valley Bank, they're thinking First Republic. And the answer is yes and no, because the damage done there is probably 1% of the damage that the Fed is doing to the banking system in other ways. And it's that damage is basically stretched out over 2 years. So it's harder to hear about damage that's stretched out over 2 years than to hear about damage that happened in a 24-hour period because of one stupid tweet, right? I mean, the bank went down because of a tweet from one of the most famous people in venture capital that went out to all the startups, and all the startups withdrew the money, $175 billion on the same day.
See, that's the thing, the run on the bank.
Right, exactly. This was the fastest run in history because it was all based on a tweet that everyone in the industry read, because every startup was subscribed to this particular gentleman, and so it was unique. But that damage is very small to the bigger damage. So that would be something that I would talk about and say, how is the Fed damaging the banking system in a way that's much, much worse than Silicon Valley Bank or First Republic? Then I often talk about inflation. Like a lot of people today are worried about inflation. And I go to these conferences and I say, no one should worry about inflation. Everyone should worry about deflation. And here's why.
Because a little bit of inflation is actually good.
It's really good, right? It's really good.
It's sort of like I own a building where it's in the Silicon Valley. And when things were going just absolute crazy, rents were going through the roof. Of course, I missed out on it because I had a locked-in lease, but I was thinking, I don't like that. I mean, in theory, as a landlord, you like it, but it's going to come back down to earth. So it's like, no, just have steady. So same thing with the real estate market in general, with houses, a nice 5% increase every year is fine. You don't like to see these 20%.
I'll take 4%. I mean, but when it's 10 or 15, then delinquency rises. All of a sudden, tenants are leaving. And churn is the killer of profit. You don't really do the math on that. You might be getting 15% rent growth, but all of a sudden, instead of people leaving every 3 years, they're leaving every 9 months. You're making less money. not more money. Most people don't do the math on that.
A good point, because my attitude is I'm very landlord friendly. I want to keep my tenants happy. Now things happen sometimes. Tenant friendly. Yeah, because sometimes things happen that are not under my control. But if it is, I even though I love my real estate broker, I prefer not to pay new commissions. I don't want to pay any TIs if I can get away with it, and I don't want any downtime. So that kind of goes along with what you're talking about.
Yeah. So I talk at conferences about, rent growth projections, vacancy projections for multifamily, things like that, because that's, single family and multifamily are my asset classes. I have a portfolio of about $1 billion assets in 16 different markets. And so you learn a lot from those markets. You learn a bunch of new things that you didn't know about. So I basically I'm good at taking those and presenting them at various conferences. But maybe in one of the segments, I can basically explain to you how the Fed is breaking the banking system, and it's not First Republic.
In our next segment, we're going to go to a break here pretty soon. I just want to ask you a quick question before we get into that in the next segment. Do you have like a bunch of different funds? Is that how you control the $1 billion?
Yeah. So I have multifamily funds. I have built to rent funds. So built to rent essentially is townhomes that are built to rent. So they're not apartments, they're townhomes. So it feels like a single family backyard, small front yard. So sort of a lower density feel, but you're still a tenant. So I do a lot of those. And then other stuff like flex industrial, student housing, self-storage, all sorts of different funds.
How long have you been doing this?
So I did real estate on my own for 11 years, from 2003 to 2014. And then from 2014 to 2023, I've been doing it with other people's money. We also call it OPM, which most people call it opium.
Opium. Yeah. All right, we're going to go to our second trivia question here. Now, we already talked about Bill Russell won the most championships with 11. Question, who is second place behind Bill Russell for the most championships? Name the person and let's put it this way, name the number, and then we know it's less than 11. And bonus points if you happen to know the name of the player. All right, 888-912-1190. First caller with correct answer was that Tanning Certificate. Stay with us, the Best of Investing. We'll be right back. Welcome back to the Best of Investing one more time. I'm Edward Brown, your host, along with Neal Bawa. And I love saying that name, Neal Bawa. I like that. Okay, second trivia question. Who is in second place behind Bill Russell for the most championships won as a player?
I'm a data scientist, so I do math in my head. I would say that whoever it is was in the same team as the first guy.
Very good. Very good.
I'm right.
You are correct. Okay, but who's the player and how many championships? We know it's less than 11.
I don't know.
Well, but that was very good, very astute. The number is 10. And it was Sam Jones, who played along with Bill Russell.
Awesome. Same team, right? All right. Okay, good. Math wins.
Yeah, no, I've always loved math. Hey, I had 6 years of high school, so I really finally got my math down. Also want to make a mention here, excuse me, for Alcatraz tours. I don't know if you've ever been to Alcatraz, but they have a cruise, a little sort of a mini cruise ferry type thing. And you go to Alcatraz, check it out. It's a beautiful ferry ride. Check it out, alcatraztours.com. All right, so Neal Bawa, tell us about breaking the Fed, the banking system.
Yeah, it wasn't First Republic. It wasn't Silicon Valley Bank. And here's the biggest reason why. So who was hurt when First Republic failed or Silicon Valley failed? Well, the people that were hurt, they were the shareholders, right? The shareholders of those banks. Now, if you think about it, those shareholders lost billions of dollars in value, right? Firstly, billions is a small number when it comes to banks, so keep that in mind. But then did you notice that a few days later, the major banks that the deposits fled to, all of them, their shareholding value increased? Chase, Bank of America, Wells Fargo. So on a net basis, while people lost billions of dollars, people also made billions of dollars. The deposits simply moved from one flag to another flag. So in the end, the banking system actually didn't break or didn't even have a challenge, right? Individual investors had challenge, but people lose money in the stock market every day of the year, and people make money. So that wasn't the break. The break is, and it's happening every single day of the year, is that because the Fed has goofed up. Basically they said inflation was transitory, and it wasn't. And because they goofed up, and now they have to raise rates 550 basis points or 5.5%.
Yeah.
Because of that, the smaller banks in the United States, and we're talking about banks with deposits under 200 billion, right? So, Silicon Valley was mid-sized because it was over 200 billion, right? First Republic was over 200 billion, but the smaller banks below that $200 billion mark, those banks, they were making $1.9 trillion of commercial loans to commercial real estate. So we're talking office, retail, strip malls, self-storage buildings, all of the different kinds of commercial real estate. Now, they were making less to multifamily because multifamily gets cheaper loans from the government, from government subsidized entities called Fannie Mae, Freddie Mac, and HUD. These are government subsidized, but they're focused more on the multifamily and single family side. So the commercial real estate guys, basically these banks were making massive amounts of loans. $1.9 trillion of those loans are coming due in the next 3 years. And because of what the Fed did, almost none of these, I'll say maybe 50% of these cannot be refinanced, which means that this commercial
can't, because the interest rates have gone up, and
because the interest rates have gone up and the values have gone down. So today, if you want to refinance these, the banks will give you so little money that you just can't refinance. So you have no option but to sell your property.
Can you renegotiate with the bank that you have the loan with because they don't want to take it back?
As far as I know, no bank has done that at this point of time, even though hundreds and hundreds of these buildings have already gone under in the last 6 months. So nobody's done that. Now, I did notice that some banks were doing it in 2008 when there was extreme contagion, but we're nowhere near that level, because if you look at the overall.
Yeah. And you're kind of freezing up there, Neal. I see this face with you may have to go back out and come back in, only because we kind of lost you there. And while you do that, I am going to continue on. It's interesting you're mentioning about shareholders losing money in Silicon Valley Bank. And it reminds me of in the old days when I used to sell a lot of insurance. Some of the companies I used were smaller, but they'd been around over 100 years. And people would ask, well, how do I know that this insurance company is going to pay? And the answer was that unless there's a fraud company out there, all insurance companies have always paid the claims. Now, the shareholders might get hurt, and even the annuity holders might get hurt, but the but the policy holders don't get hurt. So if somebody died, a lot of these insurance companies get reinsurance, and they go ahead and reinsure with another company, very similar to the banking system. So depositors didn't get hurt with the banks, but shareholders are on the stock. Those guys got hurt. Same thing with the insurance companies. That's kind of how that works. All right. While Neal is trying to log back in, somehow we lost his signal. I don't know what happened. He was right in the middle of a great story about the banking system getting broken and all these loans coming due in the next few years. It'll be very, very interesting. I want to definitely get him back so we can finish that off. But in the meantime, we are going to go to our third trivia question here, which is, in 2015, Klay Thompson dropped 37 points in a single quarter. The question is, which team was this against? That's our trivia question. Call 888-912-1190. First caller with correct answer wins that tanning certificate. And don't touch that dial, because we are going to be right back. Welcome back to the Best of Investing. Again, I'm Edward Brown, your host, along with my special guest, Neal Bawa, who just came back in. So Neal, you didn't hear the trivia question, but I'm going to ask it right now and see if you know the answer to it. In 2015, Klay Thompson dropped 37 points in a single quarter. Which team was this against? Remember that he set the
not
record.
A choice. Yeah, no, I'm a very recent basketball fan, so I'm Though I do follow the Golden State Warriors.
Okay.
So, but no, I wouldn't know.
No, okay, Sacramento Kings.
Kings.
That's who we did it about. Okay, so you were just before you cut out accidentally. You were talking about the Fed breaking the banking system.
Right, and it's the Fed's breaking the banking system in pieces, in steps, every single month, because these small and mid-sized banks were the biggest lenders to commercial real estate, especially the office segment. And what's happened with the Fed raising rates so fast, so quickly, that that sector really hasn't had time to adjust. So the multifamily market has exposure to about $75 billion of maturing loans in 2024 and 2025. That number is actually tiny compared to the office sector, because the office sector has exposure that may be in the 150 to $200 billion range. And this is extreme risk for the banks, for these mid-sized banks, because what's happened is multifamily values have declined by about 20, 25, 30%, depending upon the market. So let's just call it 20 to 30%.
Is
But
that right?
office,
Have they
yeah,
really declined
yep,
that fast? Is it all
they
because of
have.
cap rates?
All because of cap rate. So we, and because I, we make 2 to 3 offers a week, and so the average cap rate that we are making offers at today is about 5.6. The average cap rate was 4.2 about 18 months ago. The difference between 4.2 and 5.6 seems small, but it's about 25, 30%.
Well, wait a minute. Let me ask you, but just based on that, how can you afford to buy at a 5.6 cap rate if you have to go and borrow them? But I mean, what's the rate of interest that you're borrowing from the banks at now?
Usually over 6. So we're borrowing 6.1, 6.2, 6.3. So one can say you're negative equity, right? So there's
unless there's so much value add because the rents were really low. But go ahead.
So when you're starting out, you're upside down. Basically, if you don't provide a very significant amount of rent bumps through value add, you're going to stay negative, and you're probably going to lose all of your equity, right? So that's the situation that there is today. Now, one good news is there's a lot of loans out there where you can assume somebody else's loan, and maybe they were at 4%, 3.5%. We've just assumed a loan at 4.2%. So then now all of a sudden you have positive leverage, even though you're paying 25 to 30% less than you were paying 18 to 24 months ago.
And usually what you just pay like 1 point to assume the loan?
Yes, 1 point. So 1 percentage point to assume the loan. Fannie Mae, Freddie Mac, and a bunch of others allow you to assume loans. And loan assumption wasn't a big deal, but all of a sudden it's the biggest deal in multifamily. Here's the challenge. You can do that for multifamily because the asset class is still robust. 95% occupancy, 2 to 3% rent growth every year. It's slowing down. It used to be like 8%, but now it's 2%, 3%. Still, it's a growing asset class. How do you do that for office? So office is in the biggest, most catastrophic space that it's ever been. 2008 looks like a walk in the park compared to where they are today. Because when you look at the companies that, the card swiping companies, they gather data from card swipes at offices. Well, only about 50, depending upon the markets, only about 55% to 65% of card swipes are happening. So every company is shrinking the total amount of space that they need. So as these contracts come up for renewal, these office space contracts come up for renewal, the renewal numbers are absolutely horrifying.
Is it mostly still working from home type of remote?
It's not work from home. It's the fact that now there's more flexibility. So let's say before COVID, people were working in the office 4 days a week and working from home 1 day a week. Well, now those people have the flexibility to work in the office 3 days a week and work from home 2 days a week. That one extra day spread out across 50 million office workers is a massive amount of real estate, that commercial real estate that certainly isn't needed at all. Right? So San Francisco is the hardest hit. A building, and this is a building that most people kind of, if you think about San Francisco, you might actually recognize this. So this is a Wells Fargo building, right? It's actually down the road from Salesforce. So Salesforce, so it's about 500 yards away from the Salesforce building. This building, this Wells Fargo building, was appraised at $1,000 a square foot in 2019 and just sold for $200 a square foot. That's an 80% decline.
Yeah, I mean, 1,000 a square foot for an office building is a little ridiculous to begin with.
It's ridiculous, right? It's excessive.
$200 is too cheap. There was, in fact, one of the hotels. 10% of all of San Francisco's hotels just disappeared overnight because they just handed it over to the bank. And in fact,
they just did. Well, 2 of the biggest hotels just did, the Park 55 and the Midtown. These are large hotels, $750 million in mortgages. keys handed back to the bank. And then
Yes.
the mall that was next to both hotels, the Westfield Mall
Yeah.
had a $553 million mortgage. Westfield just handed the keys back. So what's happening is that it's not, so the hotels are collapsing because the offices no longer have enough people. The offices mean that retail doesn't have enough people. That retail is affecting the malls.
Yeah.
The malls are affecting the hotels. So you have this catastrophic chain that's happening, not just in San Francisco, it's happening in other markets, but San Francisco is the poster child for what's happening. And the exposure is all the mid-sized banks that were loaning to these people, and it accelerates over the next 2 years from here. That's
So
what I mean by the Fed broke the banking system.
Yeah, interesting. So it's funny because, I work a lot with Pacific Private Money and we lend, but our primary focus is single family houses, first position. And the way I've kind of looked at it when I'm speaking to people is everybody needs a place to live. And so, not everybody needs an office building. Not everybody has to go to the mall, especially, with Amazon and that sort of thing. But it is a little scary. I mean, what do they need to? We're going to go to a break here in about just a minute, less than a minute. What does the bank, or the Fed need to do? Just lower interest rates? I mean, that's.
I think will start the healing process, because there's a lot of really awful quality offices that nobody can really save. But there's good quality offices that should be refinanced, that should be liquid, that are occupied at maybe 90%, but still the value decline is the issue. Well, if rates go down 2%, we're good.
Okay, very good. All right, stay with us. The Best of Investing. We'll be right back with some closing comments. Don't touch that dial. Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with Neal Bawa, my special guest. This has been awesome. And Neal, there's a lot of questions we didn't even get a chance to do, so we're going to definitely have to have you on again. Is now a good time to buy or build real estate?
In my mind, now is not a good time to build real estate, and now is a good time to corner land. Land has become illiquid. So I'll give you an example. These are real examples, right? 18 months ago, maybe 24 months ago, if I'm buying 10 acres of land, I'm paying 2x what I'm paying today. And I have to close on the land in 120 days. And then I have to carry that cost while I spend almost 2 years zoning and permitting and entitling it and getting it to the point where it actually can start construction. So that carry costs is a killer, right? Plus you're paying twice as much. So today I'm able to pay half what I was paying 24 months ago. And I'm able to sign a contract that gives me 18 months, during which time I can do the zoning and permitting and entitling, but I haven't bought the land yet. So today, squatting on land, this is really land squatting, not land banking. For land banking, you have to buy it, right? Here, I have a contract and I basically give somebody $50,000 deposit, and that's all really I'm in for. And now I can basically drag it out for another 18 months. So the bad time to build, because construction costs are still high. They're coming down, but they're still high. Also, and interest rates are high, but I'm absolutely 100% convinced that they're going to come down. But a great time to be preparing to construct at the end of 2024. That would be an incredible time to invest in.
So are you?
And also,
is it an option that you have, or you're actually in contract to buy it? You have to buy it, but you're just tying up the 50,000.
I'm in contract to buy these, and I have a $50,000 deposit, and I eventually walk away, I'll lose my deposit, right? If I walk away in the first 4 months, I won't lose anything. If I walk away 18 months later, then I'll probably lose my $50,000 deposit in almost every case. But that's the risk of, you take in business, right? Well, I'm taking the risk all the time. 2 years ago, this piece of land, today it's maybe 2 million. Before it was 4 million. So I'm paying half, but I'm also saving another 30% in carrying costs. So I'm basically getting an 80% discount on land compared to where I was before. So that's an incredible opportunity.
And those landowners are basically just dumping the land.
Well, they want to be in contract, right? They want some out. The only options are to give people more time. So it's flexibility is really what matters today. If you're a landowner, you want to sell, you've got to be flexible.
But they're cutting it in half too from what it was.
Well, some of that is because land becomes illiquid much faster than any other form of real estate when rates go up. So
which is why
it's the most sensitive.
I tend to stay away from land personally. I don't like the risk on that. Everybody needs a place to live. I like, to give people a mortgage. And in fact, on our Southwest fund, we're buying discounted mortgages, and especially with all the kind of weird fallout that's going on. So our average loan to value is only 51%, but because we're buying at a discount, it's 37%. So
Wow.
I don't know too many more conservative investments out there, and we're paying just a flat 8.5%. So,
That's
but
pretty nice.
there's no growth unless you just reinvest the distributions, and then you
Right,
get,
right.
about 8.75 or close to 9 maybe, but we give up the growth. I'd rather just sleep at night. I'm not a gunslinger, Well, Neal, I tell you, it's been an absolute pleasure. We're definitely going to have you on again. Definitely click back on my Calendly so you can get back on, because this has been great. And there's a whole bunch of stuff I know we didn't even get a chance to do. But here's our thoughts of the day. So the first time I got a universal remote control, I thought to myself, this changes everything. And when life gives you melons, you might be dyslexic. All right, tune in next week to the best of investing. And those aren't even my best ones. I got better ones. Tune in next week to the best of investing. We're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. Slow long.